2023, the road ahead. What's next for crypto? That's a question asked by and answered in part by our next guest, Paul Brody, Ernst & Young Principal and Global Innovation Leader and CoinDesk contributor. Paul, welcome to our show. You wrote an article for our CoinDesk Theme Week 2023. What are some of the lessons learned this year that we may carry on to the next?
Then my theme of my article was there will be no lessons learned. And I think, depending on your point of view, basically this year proved it, whatever it is. If you think crypto is all a big scam, then you have plenty of evidence to support your case. If you think that only thing that works is DeFi, you got evidence to support that case. Whatever it is that people believe, they saw proof of that in this last year. So I'm afraid, at least when it comes to really learning lessons from the year, I'm a bit of a cynic. I think people won't have learned any really substantial lessons.
Do you think that one of the things they might have learned, though, is, or at least do you think one of the things to come away from this is that maybe there's been too much of a focus on the idea of just trading currencies? And in essence, cryptocurrencies have become just gambling tools, and they haven't been about the actual applications that they're supposed to be about. Do you think that's going to change at all in 2023, or are we going to see more of the same? Are we going to see more of the altcoin casino aspect of it? I'm using polite family terms rather than the application aspect of it.
So I hope that, if nothing else, the last year has kind of deflated the crypto casino. And what we get to see in the next year is less focus on financialization, more focus on industrial applications. It doesn't mean that there's no financial future for crypto and for blockchain and for stable coins. And we're going to go through a period of some pretty intense regulation and enforcement actions. But I think overall next year, my hope is that we'll get to focus on the things like ESG application, supply chain management, asset tokenization. And when I say asset, I don't mean financial asset. I mean real world assets, putting them to use. So that's my hope for the coming year. And we're certainly going to I'm going to try to make that real by introducing products and technologies that support that.
Nonetheless, do you find it harder with talking to institutions, et cetera, and potential venture capitalists about getting into the space, given the sort of high-profile collapses of the financialization of crypto, the FTXs and the Terra Lunas of the world, and 3 Hours Capital, and all these names imploding? Do you think that it scares off a lot of institutions from investing in that infrastructure stuff and investing in applications, real world applications that could go to market?
Definitely, it's not a universal thing. So if I think about the conversations that I've had in the last few weeks, there's been a couple where the clients just said, we've changed our minds. This isn't for us. There's been a couple where internal advocates have said, I'm not deterred, but I don't think this is a time when I can sell this inside of my large enterprise. And then there's been quite a few where people have said to me, we're ready to go forward. We're continuing to move. We might not move at quite the same pace because we are encountering more skepticism from other parts of the organization, but we're still ready to go forward. We've not seen any pullback in supply chain or business operations. The only places where we've seen some pullback is on the financial services side. And even there, it's really clients saying, we might have to go slower, not that we're going to stop.
Talking about big collapses in the crypto industry, we're now looking at Sam Bankman-Fried's, he did his media tour in the previous weeks. Now he's going on a congressional tour this week, and perhaps after that, a court tour. But thinking of, this very big and exposed strategy of laying out his case, I wonder what your thoughts are on that.
So we never comment on specific companies or cases or individuals. What I can say is I feel like the last 3 or 4 months has over and over again reiterated a couple of things that are really, really important. Number one, you really have got to have business controls. And you hear people talking about things like proof of reserves, but proof of reserves, even with liabilities, is not enough. You've got to have confidence that the people who you are trusting, and you have to choose to trust somebody, whether it's an exchange or some other interface point, the people you trust are behaving in a reputable way. And so I do think the winners here are the ones who have embraced public regulation, the ones who have asked to be regulated, the ones who have hired top-tier auditors and invested the money in regulatory compliance. So I think even though a lot of people will say what this last year proves is that only on-chain sort of pure DeFi works, I think the bigger lesson is that transparency isn't as easy as it looks, and that in fact you need regulatory compliance and you need external inspection by true experts on things like liabilities and business controls.
It's interesting you say that, because yes, a lot of people said self-custody is the way, and wasn't that the argument for the industry for Bitcoin in the first place, was that you could have a trustless system. You could custody your own assets, finances, have a bank in your pocket, so to speak. On the flip side, okay, if we're trusting companies, the argument has always been, yeah, we want more transparency, but there's no regulatory clarity. And so until we get that, I mean, we're still going to have stablecoins that are not audited, that are a little opaque. And so where do we go from there?
You've nailed on kind of the toughest question, which is, I think actually we would have much better quality participation and much more participation in this market if there were clear rules. We talk to many companies. We have clients, they have stable coins sitting on the shelf ready to go. They want to be regulated. They will not launch them until they get a clear yes from the relevant regulators to do so. So we have very direct experience that says that when regulators set very clear rules, they will be rewarded with a flood of high quality participants in this marketplace. And until then, those highest quality participants will actually stay out of the market. And that's not going to benefit the growth or the maturity of this market.
So, Paul, before we go, two questions. Of course, I got to ask. First of all, updates with Ethereum, what's happening this coming year? And then second of all, speaking of Ethereum, you're working on something on Polygon, which is, of course, is a layer 2 on Ethereum, something called Nightfall, which sounds a lot like a Bond sequel.
It's not a Bond sequel. We'll start with the first one, which is predictions for the year ahead for Ethereum. This is by almost every dimension, Ethereum has long passed Bitcoin. It will continue to be kind of an exceptionally strong environment. Ethereum is a bet on a programmable digital ecosystem. So to the extent that there's a shift towards industrial and non-purely financial applications, we'll see them on Ethereum, and Ethereum will continue to be really dominant in 2023. From an EY perspective, one of our big priorities and one of the things we've been working on with Polygon is a system called Nightfall. And Nightfall is a privacy-enabled, ZK-optimistic rollup that's designed for enterprises. We're going to have the Nightfall kind of production edition released in January on the mainnet and on the Polygon proof-of-stake network. And along the way, we've made a couple of really important changes that I think are going to get a lot of attention. Number one, we have shifted it so that it is a fully and completely decentralized application. So EY and Polygon have always committed to make the source code fully public domain and open source. We've now made it it's a fully decentralized application. Once it's deployed, it is irrevocably deployed. It cannot be managed or upgraded. So that's the first thing, is we've completed full decentralization. Secondly, and I think equally importantly, because Nightfall is targeted at enterprise users, we are requiring that the code requires that you have an enterprise X.509, which is basically an enterprise SSL certificate to use them. And this is a really important step. It basically means that although Nightfall enables privacy, it does not support anonymity. You have to be an enterprise, you have to be identified as such, and in order to get an X.509 certificate, you actually have to go through a screening against the major sanctions list. Now, I believe we picked this for a very specific reason, which is we didn't want to support money laundering, we didn't want to enable anonymous assets and payment transfers. We wanted to support privacy without total anonymity, but we wanted to do it in a way that retained a fully permissionless and open structure. And to do that, we relied upon another genuinely public and decentralized model, which is the SSL certificate model, which is used on the internet. So those are two really big changes. And we're also going to rely upon the community members to deploy the contract so that both EY and Polygon are fully and completely independent of this. There's no backdoors, there's no control, there's nothing that people should have doubts about as this gets deployed into the ecosystem in January. But I hope it will trigger a big wave of industrial applications using privacy for business tools.